Today we have a new stock in the portfolio, and as you might have guessed it, it is a uranium play. And the question is, are we in the third super cycle of uranium? We've had two. One was in the early to mid 70s. The second was the early to mid 2000s. And then the question is, are we in one now? Of course, that question has been being asked since, 2015. So one might ask, why is now the time? So this is going back to November of 2021. That's given us a year and 3 months to consolidate. The question is it going to break out or break down out of this wedge? But before we get into that, let's review this prior week's account. And as you see, I purchased one share of URNM. That's the Sprott Uranium Miners ETF. And then I added one share of REG, Transoceans. And BTU is, well, doing not much. Actually, losing a few percent over the past week. Of course, I would have loved to get in during the flash crash of the past week, where I think RIG within the first couple of minutes of trading saw prices go between $5 to $7.50. So didn't get in any of that, but I guess that is a good reminder about having stop losses, because that would have been a shame to have a stop loss to get shook out to then only have the price go back to where it was and all within 2 minutes, and now you don't have a position, and that's unfortunate. So, a catalyst, we're not going to get too deep into it because there's a lot to it. A catalyst was the coming about of the Sprott Physical Uranium Closed-In Trust. And they began around July of 2021. And pretty much what they do is they vacuum up uranium that's on the market. And right now they have close to 59 million pounds of uranium. And they'll say whatever they want, but the point of this is to corner the market and squeeze the price. And somehow they make money off of that and assets under management, because it has an expense ratio. So you pay them to do this, and fun for all of that. So, well, I bought URNM, trades at a premium, and it trades at a discount to NAV, net asset value. I bought it slightly above in the premium. Shouldn't have done that, but it is what it is. I really started looking back into uranium around March or April of 2022, and the way I justified purchasing this is post hoc rationalization and justification to try to explain away my FOMO, let's call it, because I've been eyeballing this whole year and it's not pulling back. And that's not to say it hasn't or won't pull back, because I'm sure it will, and I'll buy more then. But I wanted exposure just in case. And really the thing that pushed me over the edge was Kazatomprom, which is the global largest producer, which is domiciled in Kazakhstan, saying that they're going to fall short of their production expectations. And between that and the recent Davos event, where all the global elites come along and enjoy themselves, let's just call it, those two kind of event news things just pushed my emotions over the edge, you could say. Anyway, enough of that rambling. So right now it trades between a premium and discount to NAV, and right now we're currently a little above. And as you see, it's actually in the last year traded more days at a discount to NAV than a premium to NAV. But that was then, and this is now, and the future is the future. So see what happens. So there's 3 points or 3 sections to address here. Why uranium, which we're not going to really get into today. A quick Google search will flood you with the necessary information as to what the bullish thesis for uranium is. So you have why uranium, why my preferred expression towards uranium and why not my expression that I'm not expressing, which is really to say, why not just buy a bunch of junior miners and explorers? And so really the way to play this is, for the average folk, the retail investor, you can buy the Sprott Physical Uranium Trust, ticker symbol SRUUF, but my brokerage account, which by the way would be my preferred means of expressing my desire to trade it, but the problem is my broker makes it where I have to put the order on over the phone, even though I think I can sell without having to call. But that in and of itself served its purpose, which is to prevent me from aiding and assisting and abating or helping the trust corner the market. So that stopped me, even though I believe Fidelity allows you to put in an order without doing it over the phone. And if you have an international broker's account or something, then you can do it with that, no problem. So you have SRUUF, then you have ticker symbol URNM, and then you have ticker symbol URA. So what this video is going to boil down to is why URNM over URA. And we're going to start with the top 10 holdings for both of them. So URNM, the top 10 holdings, we're not going to go through them all, but what I'm looking for are three entities. As far as I'm concerned, many times one of the best ways to play a commodity is through the physical commodity in and of itself. There's less risk, there's less idiosyncratic risk of management, there's less risk of geopolitical risk, there's less nationalization risk, there's no earnings miss. Commodities don't have earnings. So there's a lot less risks, but of course with that caps the upside. And I'm not going to get into it too much, but one of the reasons I don't want to play the junior miners is because a lot of them won't, at the end of the day, you're actually investing in companies. And most of these junior uranium miners will never actually see the spot price of the uranium, because they'll either be locked in contracts or they'll still be exploring, or by the time they finally develop the mine, the price will have crescendoed and waterfalled, and enough production will have come online from the actual producers, or something will happen that they will never see it. Now, that doesn't mean that their stock won't see it. So you do have to remember the difference between owning stock and owning a company, and you don't want to conflate categories. So I'm well aware of that. I'm buying, by purchasing this ETF, a bunch of pump and dumps, a bunch of shitcos, a bunch of Ponzi's, a bunch of frauds, a bunch of stock promotes. I'm well aware of that, and I'm okay with that. But the differentiating factor are twofold between URNM and URA. Number one, URNM is more concentrated in actual uranium exposure, whether that's real companies that actually produce real uranium or whether that's companies pretending to do uranium stuff. Either way, they're both highly leveraged in relation to uranium. As we'll find out with URA, many of the companies in there have minimal exposure to it, and they're not necessarily going to fall into the crowd of uranium pump and dumps. And since I would like to think of myself value-ish investor-like, the second reason is that URNM has exposure to three things I'm looking at. That's Yellow Cake, that's Sprott Physical Uranium Trust, and that's Kazatomprom. Kazatomprom is based in Kazakhstan, and they're the world's largest producer and lowest cost producer. The type of thing you might actually be interested in if you were a real person who invested in companies and not stocks. Now, there's risks that come with that. Perhaps the affiliation with Russia and such things like that. Plus, they've had their own dramas internally in the last year. But they're the lowest cost producer and the world's largest producer. And they're 14% of the weighting. Sprott Physical Uranium Trust owns the commodity. Like I said, I want to play the commodity. So that's 13.5% almost. And then Yellow Cake is a London version, pretty much doing the same thing Sprott Physical Uranium Trust is doing. And actually, they're improved insofar as I'm concerned because they were selling some of their uranium to buy back shares to minimize the spread of the discount to NAV, which defeats the whole purpose of cornering the market if that's what we're after. So thankfully they stopped that, but Yellow Cake in this is a little over 4%. So that adds up to 31.68%. If we go to URA top 10 holdings, those three stocks, Kazatomprom, Yellow Cake, and Sprott, add up to 17%. Enough said. Almost 32% versus 17%. I'll take the first for the initial reason. Second reason, URNM has more exposure from their 11th to 20th holding of uranium plays as opposed to URA. And yet again, I'm not saying these companies will ever produce uranium, but that's okay. Because I'm looking for a pure play of, you have to know, it's okay to be a participant in a Ponzi insofar as you know that you're actually engaged in a Ponzi. It's okay to play the greater fool's theory if you're aware that you're playing the greater fool's theory. But you have to be cognizant and willing to admit that to yourself. So I have my 32% of exposure to things I really want, which really leaves a remainder of 68% of bullshit. And it is what it is. This is what I get for being lazy and not wanting to phone in an order. URA. So what you have here, and I'm going to use BHP Group as the punching bag. So their 10th place, yes, their 10th place holding, as you see, is Rio Tinto. Their 11th place holding is BHP Group. Now, you might as well say they're one and the same here. And then if you look at these, there's a bunch of global conglomerate, international conglomerate, multi-billion-dollar companies that have minimal exposure to uranium. And they're conglomerates that are tangentially associated at best with uranium. And it won't move the needle when it's all said and done. And move the needle in regards to revenue, because revenue is what, well, is a metric that affects stock price. And yet again, or after all, I'm after affecting the stock price. So BHP, to use that as an example, goes the same for Rio Tinto. And I'm kind of concerned that these are the 11th or 10th and 11th holdings. What percentage of revenue is generated from uranium? At the end of the fiscal year in June 2022, I went and read their 10K. I believe it's page 208 if you're interested. And it says that they mined 2,375 metric tons of uranium. At $50, which is around where uranium is trading today, that's roughly $262 million of money generated. Now, the irony is what they've done in uranium is more than, I would say, half of the holdings in either one of these ETFs have generated. Because they're actually a real producer of uranium. The downside is it's so little in regards to all the other stuff they're doing, it's just not going to make an impactful, differentiating, sufficient difference. Their revenue was $65 billion. That's 0.4% of revenue. And even if that $262 million is just written off and is considered all profit and it goes into the all sustainable costs of mining the copper at their mine, and it's just incorporated in that, and it's all profit, it still doesn't, it doesn't matter. Uranium would have to become hundreds and hundreds of dollars for it to actually start making anything more than a marginal difference. The Olympic Dam, which is where this uranium is extracted from, is a copper mine. And it's a byproduct of the copper mine. And it's price inelastic because they don't care what they sell it for. They just want it off their books. They just want it gone. And interestingly enough, this is also one of the bear cases against the supply shortage argument that many bull uranium investors are talking about, because one of the concerns is that, let's say global production is around 140 million pounds of uranium a year, and global consumption is around 190 million pounds a year, give or take 10 or 15 million pounds. And one of the arguments is that the argument is that the deficit is increasing more and more, but some of the counter arguments is you have people dumping on the secondary market that aren't primary producers of uranium but still produce it nonetheless, like BHP and Rio Tinto, and they're the ones making up the difference between primary production and consumption. And insofar as that continues, uranium prices aren't going to be able to squeeze, and that right-tailed risk or right-tailed reward of it rocket ship emojiing to the moon isn't going to manifest and develop and realize. And so to say that BHP, you can't buy PHP saying, I'm ready for the stock price to reflect uranium going to the moon, and then on the same hand saying BHP is causing the suppression of uranium prices due to its dumping. So that's cognitive dissonance. So let's not suffer from that, because that's a good way to lose money in the long run. It's a poor decision-making process. And I'll end it here. The Sprott Uranium Mining ETF, I just realized, oh, yes, I'm sorry. The Sprott ETF versus the Global X ETF. The Global X Uranium ETF has been around for a decade plus. The Sprott Uranium Mining ETF began its inception, I believe, in December of 2019. So we don't have 5 years. I'm saying all of this because the bottom chart says 5 years is highlighted, but it actually doesn't go back 5 years. And if you're not paying attention, you won't notice that. And I don't want to be called intellectually dishonest or disingenuous. So the top chart shows the last year. They pretty much tracked in accordance with each other. So it doesn't matter. Everything I just said doesn't matter. Like, sounds good in theory, but in practice, it doesn't matter. Fair enough. Now, if we go farther back, since inception, that's little over 2 years of, 3 years of information, we have a different picture, which is why you always want to look at charts on different time scales. And so we have 3 years of information, and what it shows is that maybe there actually is a meaningful difference, because the Sprott Uranium, URNM, the one I've purchased, is up 188%, while the Global X is up 110%. Now, you would have done well either way. You would have outperformed the market, and good for you, insofar as you consider the market the S&P 500, which is what I'm saying it is. And because that's my benchmark, so as far as I'm concerned, that's what it is. So there is a meaningful difference here. So what it means, because what I would think is that the last year has kind of been shit, just for the market in large part. And uranium hasn't done much. Well, it's been volatile, but it's kind of flattish for the last year, up 10%, which is better than the S&P was at, down 15%. So you actually would have outperformed the market by 25%. So good for you. But what I'm getting at here is that the Global X has a bunch of these larger play, more diversified, like BHP and Rio Tinto, which should indicate that during down periods, and I'm sure this will manifest after a blow off top and a exponential rise if that does ever occur, even though they both will suffer miserably. But what it should suggest is that the Global X fund in bad years should do better than Sprott, but actually did worse. And that's worth thinking about. So it seems like in up markets, Sprott does a lot better, and in sideways, you can't really call it a down market, even though from all-time highs to where it ended the year, it was down. But on sideways to slightly up markets, it underperforms. So hopefully we don't have a down year this year to find out what happens and to prove a counterfactual true or not true. But what I'm getting at here is URNM, and this isn't post hoc rationalization. I actually figured this out correctly. I didn't decide to buy Sprott and then try to justify why. I looked at both of the internal metrics and components before I did any of this. I actually did this at the very end to see how they compared to support my thesis or to disprove my thesis. And it seems to support it. And here we are. And that's the end of this. Thank you for watching. And until next week, which will, by the way, get into, unless something happens, I'm going to try to delineate and explain, well, one of the other two segments. As I said, there's 3 segments. Why uranium, why URNM as an expression of that, and why not junior miners, which in a way I still have 62% exposed to less than ideal exposure, let's call it. So I'll either cover one of those 2 segments next week unless something big happens, and then I'll probably cover whatever that big thing is. But you know, if rig falls 30%, then might be covering that, unless this falls 30%, which in case I'll just probably continue covering why uranium and or why not the smallest players. Thank you for watching.